Welcome to another Explainer. Today, we are taking a really rigorous expert-level look at a topic that honestly catches countless international entrepreneurs completely off guard. We're talking about US compliance mechanisms for foreign-owned entities. Specifically, we're going to dive into the deep, often misunderstood mechanisms surrounding Form 5472. We've pulled this analysis from comprehensive, anonymous expert industry reports to bring you the real story. We're going to examine the core ideas, those hidden infrastructure bottlenecks, and the strict cause and effect relationships that govern foreign-owned single-member LLCs operating in the US. So if you're sitting there thinking that having zero US revenue makes you completely invisible to the system, well, you really need to pay close attention to this.
Here is the exact matrix we'll be using today to dismantle some of the most common compliance misconceptions. Number 1, the informational reporting mandate. Number 2, tax liability versus reporting. 3, formation as reportable transactions. 4, infrastructure bottlenecks and timelines. And finally, number 5, severe non-compliance penalties. Let's jump right in. Section 1, the informational reporting mandate. Okay, the fundamental, absolute, non-negotiable baseline here is this. The operational effect of establishing a US entity is an immediate informational reporting requirement. It's a strict cause and effect relationship. Picture this. You might be a software developer living in Germany, or maybe a graphic designer in Mexico, and you are operating a US LLC completely remotely without a single office or employee inside the United States. Now, you might assume that because you aren't physically there, you're just outside the system entirely. But the expert reports are crystal clear on this point. Simply owning the entity is the trigger. You see, the mandate isn't about whether you actually owe the government money. It is entirely about whether you exist on paper. Now, this mandate maps out a bit differently depending on your actual business structure. Let's break it down. For a foreign-owned solo operator with a single-member LLC, which, by the way, is the most common structure for international founders, the requirement is a pro forma Form 1120 and Form 5472. And remember, this is purely an informational return. But if you add partners and become a multi-member LLC, the whole mechanism shifts, and you have to file Form 1065 instead. And if you go the route of establishing a C corporation, well, you are locked into filing a full Form 1120, which is always mandatory, totally regardless of your revenue. So while the architecture of your compliance changes based on your specific structure, that core foundation, the fact that you absolutely must report, never ever disappears. Moving right along to Section 2. Tax liability versus reporting. So this right here is the primary friction point. This is where most foreign founders get incredibly confused. It's the strict legal separation between tax liability and informational reporting. Tax liability is triggered by what experts call effectively connected income, or ECI. Basically, if you have a physical office in Texas or employees working in New York, you are generating ECI, and that creates a requirement to actually hand over tax dollars. Informational reporting, on the other hand, is triggered by remote, non-US operations, and crucially, it does not generate a tax bill. If you're a foreign consultant doing business globally through, say, a Wyoming LLC, you likely have zero effectively connected income, which means zero US taxes owed. But, and this is a massive but, you absolutely still fall under that reporting mechanism. You still have to file the informational report. You really have to understand the implicit assumption behind this entire US regulatory framework. It's all about visibility. You might be wondering, why demand all this paperwork if no actual money is owed? Well, it's because the authorities simply will not tolerate a system where hundreds of thousands of foreign-owned assets just exist in a black box, completely untraceable. Form 5472 is basically the flashlight they use to look inside that box. They demand a trace of the transactions, and they have built a very rigid, unforgiving compliance structure to guarantee they get exactly that. Section 3. Formation as reportable transactions. Let me ask you a question, and really think about this. Does a pre-revenue, zero-income entity require a tax filing? Let's say you formed your LLC in December. You haven't even launched your product yet. You haven't made a single cent. Heck, you haven't even paid for a website domain. Do you owe the US government a complex tax filing? Now, the logical, intuitive answer for most people is no, of course not. But here's the thing. In the realm of expert tax compliance, your intuition is very often a trap. The core mechanism here hinges entirely on the definition of a reportable transaction. You see, the mere act of forming the company falls into this category. Establishing the entity, moving a little bit of money just to pay the state registration fee, getting your tax ID, these are structural events. The law does not say, hey, report to us when you finally make a profit. It strictly says report the transactions. Therefore, the initial formation of your US company is the exact cause that triggers the compliance effect, and it is entirely independent of your actual revenue stream. So how do the pros handle this? Expert tax practitioners employ a highly specific, very calculated strategy for these zero revenue entities. Here's how it flows. Step 1, the entity is officially formed and registered. Step 2, the employer identification number or EIN and a bank account are secured. Now, step 3 is the truly critical action. Even with zero income and absolutely zero expenses, the industry standard practice is to file a consolidated informational report using Form 5472. This document formally notifies the authorities of the company's creation. It fulfills that legal mandate to report the formation transaction, completely neutralizing your compliance risk before your business even begins operating. Now, I do want to give you one really actionable piece of good news when it comes to timelines. If you form your entity early in the calendar year, say January or February, you essentially gain a built-in grace period. Because these tax filing mechanisms operate on annual cycles, your first informational return won't actually be due until March or April of the following year. So you effectively get a 13 to 14 month runway to organize your compliance infrastructure and get everything in order. Section 4, infrastructure bottlenecks and timelines. On the surface, the rules seem pretty straightforward, right? A multi-member LLC has a standard filing deadline of March 15th, while a single-member LLC filing Form 5472 has a deadline of April 15th. You might look at that and think, great, I've got plenty of time. I'll just ping an accountant on April 10th and get this handled. But deep expert analysis reveals that for a foreign owner, relying on those official surface-level dates is actually a really dangerous operational trap. Let's trace this bottleneck step by step, because this is where things get crazy. The entire modern US e-filing infrastructure is completely built to process standard Social Security numbers or individual taxpayer identification numbers. But as a foreign remote operator, you typically don't have those. And because you don't fit into their neat digital architecture, you are forced into an analog mechanism. That's right, Form 5472 for foreign owners must very often be processed via physical, paper filing. This changes absolutely everything. Paper documents have to be prepared, physically or digitally signed, compiled, and then actually mailed through the postal system. Most accountants require a minimum 48-hour physical turnaround just to process this on their end. Therefore, your true practical deadline as a foreign owner isn't mid-April at all. To actually ensure compliance, your preparation timeline has to be shifted all the way back to early March. Which brings us to our final section, Section 5, Severe Non-Compliance Penalties. $25,000. Just let the gravity of that number sink in for a second. I really need to make this clear. This is not a tax bill based on your profits. This is the flat, strict financial penalty enforced by the US government simply for filing a late or even just an incomplete Form 5472 informational return. Remember what we said earlier? This form doesn't even generate tax revenue. You could literally have a company with zero revenue, zero sales, zero physical presence. But if you miss that hidden early March paper filing bottleneck we just talked about, you are instantly exposed to a disproportionately massive $25,000 penalty. The mechanism is specifically designed to be deeply punitive, strictly to enforce the government's absolute demand for total visibility. So, we have to end with this final provocative thought. Is assuming you are invisible just because you have zero US revenue really worth risking a $25,000 informational penalty? I think the data, the expert insights, and the mechanisms we've explored today overwhelmingly say no. Truly understanding the strict cause and effect nature of Form 5042 is basically the only way to safely operate a foreign-owned US entity. Thank you so much for joining me for this explainer. Keep learning, stay compliant, and I will see you next time as we break down the next complex system.